Good morning. You are watching a live daily market outlook for Wednesday, 23rd of May 2012, prepared by Windsor Brokers. The main focus today is on the Eurozone summit that is starting. This is the first day today, and most of the markets are awaiting the outcome of this meeting to take the possible new direction, as the steps expected to be taken by Eurozone officials are seen as crucial for solving current debt crisis, as so far no significant results seen from the recent austerity plans that actually caused some more troubles and increased risk of Greece as a number one problem for the Eurozone, close to be leaving the bloc and the Eurozone and the monetary union too. As a result, the risk off is still a main driver of the market, as the euro and sterling fell to their recent lows, failing to take any stronger corrective action, while commodities again came under pressure, with the crude oil hitting its fresh lows in the early hours of today, as a potential deal between Iran and the UN nuclear watchdog now is the fears for oil supply disruption, and while concerns over the debt crisis in the Eurozone and the slowing Chinese economy put additional pressure on oil demand, that overall pushed the oil price significantly lower, and it lost over $1 in the recent action, hitting a level slightly below $91 per barrel at 1994. This was the recent price, the latest low seen just a couple of minutes ago, with prospect and on technical point of view quite negative for the oil, and the possibility of further extension lower, especially with the current situation and the deals close to be done between Iran and the US officials, as well as lower the demand, keeping the heavy pressure on the oil's price. Also, gold fails after failing to regain initial barrier at 1600. Came again under pressure and extended losses below our significant supports that were, I think, mentioned on yesterday's presentation at around 1570 zone. That was sort of a break point for the gold. So far the price hit 1555, increasing risk of further weakness and revisiting our critical support at 15, 20, 30 zone. As said, today's meeting, European leaders will explore ways of breathing life into their striking economies at the summit that starts today, but the issue of Eurozone bonds and whether they can help alleviate 2 years of debt turmoil will dominate the meeting. The Spanish Prime Minister, where the economy and the banking system are at the front line of the crisis, will meet newly elected French President François Hollande in Paris ahead of evening summit to discuss policy positions, a market shift away from the traditional Franco-German axis. At nearly all previous summits over the past 2 years, Hollande's predecessor Sarkozy met German Chancellor Angela Merkel beforehand to fix a strategy, prompting criticism from other leaders about dictates from Paris and Berlin. In respect, Hollande's victory has significantly changed the terms of the debate, with his call for a greater emphasis on growth, now on a rallying cry for other leaders. That has set up a showdown with Merkel, who supports growth but whose primary objective is budget austerity and structural reform. In his first EU summit, Hollande has also chosen to make a stand on Eurobonds, the idea of mutualizing Eurozone debt, despite strong German opposition to an idea that has been hotly debated for more than 2 years. The Hollande will have support from Italian Prime Minister Monti and the European Commission President Barroso, among other leaders, but Merkel shows no sign of dropping her objections to the proposal, which she has said can only be discussed once there is much closer fiscal union in Europe. From the other members of the Union, the Netherlands, Finland, Austria, and some smaller Eurozone member states support Merkel in that position. They know that decisions, which is important, will be made at Wednesday summit, which is intended to promote ideas on jobs and growth ahead of another meeting at the end of June. But it is clear that debate over Eurobonds and related bank rescue concerns will be intense. Of course, we'll be closely watching the results and outcome of this meeting, as all eyes on the markets are now on this meeting, and this will give us more clues about further steps to be taken. Otherwise, it will be quite difficult to prevent the disastrous scenario that no one wants to see. But as currently the recent action did not give much results, and Greece is about to leave the zone, especially after the recent elections that show that the majority of Greeks are against the very strong austerity measurements that were dictated basically by Eurozone, and especially the European paymaster Germany. And now some more soft tone has been introduced in the communication with Greece in order to prevent, as said, quite bad and quite negative scenario that also might cause the domino effect and the spreading crisis over the other cash-strapped and in-debt crisis hit countries such as Spain, Italy, and Portugal. From today's calendar, already released, there was Bank of Japan interest rate decision that showed no significant changes in their policy, as the minimum rate has been kept, but the Bank of Japan keeps its powder dry, as in case of Eurozone clouds darken. The Japan kept its monetary policy steady, but dropped a pledge to pursue powerful easing and saving ammunition in case Europe's deepening debt crisis warrants further supportive action to shield the fragile Japanese economy. As immediate reaction of this was a sharp descent of dollar against Japanese yen and returning to the lower levels, actually failing to extend its short-term recovery that stalled just above psychological barrier at 80.00. Back to the calendar, further releases are Eurozone current account due at 8.00 GMT that is expected to show some increase in the Eurozone's current account, with the surplus of 4.7 billion euros forecasted for today, compared to dip to minus 1.3 billion of the previous release of the month of February. The Bank of England's MPC meeting minutes are due at 8:30 GMT, and as expected, the voting was 009 for is expected to stay unchanged, as the latest meeting of the Bank of England MPC showed a firm policy in not changing the interest rates and keeping the current support at I'm not sure about the amount, so I'm not going to say it. Anyway, UK's retail sales due at 8:30 GMT. Decrease is seen today for the month of April by 0.8% compared to healthy 1.8 growth of month of March, with the MPC member being due to have speech at 9:15 GMT. From UK, another CBI, another release at 10 o'clock GMT, CBI industrial orders expectations. A further negative tone is expected today. -10 is the forecast compared to -8. Across the ocean, Canada kicks at 12:30 GMT with retail sales for March. As improvement is seen in the March retail sales by 0.4% compared to minus 0.2% of February, with core retail sales expected to stay unchanged. A leading index from Canada for April is also expected to stay unchanged at 0.4%, while U.S. home sales due at 1400 GMT are expected to show some increase in the new home sales, with the 335,000 units expected to shown sold compared to 328,000 units in the release of March. And finally, U.S. weekly crude stocks are again forecasted to show another increase in the U.S. Oil stocks by 1 million barrels compared to build of 2.1 million barrels in the previous week release. And this is the ninth consecutive week of building up the U.S. crude stocks, mainly due to reduced demand for the energies, and also the current crisis with Iran that is hopefully going to be solved shortly, with some good deal made with Iran that will prevent further tensions in the energy market. Now we're going to take a look at the markets and see today's movements and the expectations for the major currencies as commodities. As said, Euro's short-term recovery of 126.41 low of last Friday was short-lived, as the price action stalled at 128.23 after a brief regain of 128 handle and brief break above the main bear trend line of 132.82 peak, as 55 days exponential moving average firmly capped the upside, and mild corrective action seen just above 23.6% Fibonacci retracement of the entire move from 132.82 to 126.41, with the fresh risk of action and the negative sentiment pushing the pair down to fully retrace the recent short-term recovery action of 126.41 that peaked at 128.23. The negative prospect for the pair sees the further extension lower, with current consolidative corrective action seen on the oversold and overextended near-term studies as shown on the hourly chart, and expects no stronger impact on the pair, as initial barriers lie at 126.85 zone, which are the previous highs, and 23.6% retracement, along with descending 20 days exponential moving average currently at 126.95 and 127 as a figure resistance. At this point, I would say only regain of 127.30-50 zone, where are the 50 and the 61.8% retracement of the near-term down leg from 128.23 to 126.41, and as well as 55 days exponential moving average would ease the current bear pressure and turn the immediate focus off 126.41 and the more significant our short-term target at 126.22 yearly low posted on 13th of January. But this is expected to be just short-lived, as the main sentiment remains very negative, and the very negative studies shown on the daily chart keep the focus firmly at the downside. Overextended conditions on the daily also might be signaling some stronger corrective action. So far, the recent action was quite mild, and I would say only regain of a minimum 129.50, 130 zone. Previous strong support would give some more significant results in the recovery of the pair. Otherwise, further weakness and the loss of 126.22 is still seen as a likely scenario, as the larger picture shows the pair in the unobstructed downtrend from 2011 peak at 149.38 and especially the break of the main bull trend line at 127.60 zone keeps the focus lower. Would break below 126.22, 126.00, likely to turn a short-term focus down towards 120 zone. That is seen by a number of analysts in the recent polls and interviews that show that most of the technical analysts are favoring the downside and the possible retest of the 2010 low at 118.75 in the months that are due to come, as well as a negative negative outlook for the Eurozone and the current recent failures in solving the Eurozone crisis keep investors in the quite negative sentiment, and keeps the single currency under heavy pressure for now. Sterling also ended its mild recovery of 157.31 last Friday's low as a brief break above 158. Handle was capped firmly at 158.40 zone, and the subsequent easing returned back to 157.31, keeping the focus at the downside. These studies on the lower time frames maintain negative tone and see no much of any corrective action so far, as 158.40 for now keeps the upside well protected, and a break below 157.31 is expected to, especially that yesterday's closing below 200 days moving average, that brief break higher proved to be false and short-lived. Close below this important dynamic resistance keeps additional pressure on the pair. A loss of 157.31 to open 157 as a round figure and psychological support ahead of more significant 156.40 mid-February range floor, and the 61.8% of retracement of larger upleg from 152.33 to 163.00. Also the reversal of 163 peak of 2012 posted on 30th of April has so far retraced quite a good part of its initial rally, with over 50% seen. Next, with break below 156.40 to open next very significant support at 156.00, higher low of 12th of March, as well as round figure and psychological support, that loss of which will dampen medium-term bulls of January's low at 152.33 and basically bring that level back into focus. Dollar yen also lost traction. It's a short-term recovery of 79.00 that stalled just above 80.00 as our initial and strong psychological barrier, with 80.13 seen only above this level, followed by a sharp reversal that shows still the pair under pressure, and any recovery attempts are seen so far quite limited, not allowing any stronger recovery. As recent dip of yesterday's peak at 80.13 reached 79.44, the previous strong resistance and range top that kept upside limited for a couple of days, as well as a 61.8% Fibonacci retracement of the move from 79 to 80.13. The immediate focus is now at the downside as the pair broke below both near-term moving averages at 55 and 20 days, and likely break below 79.40 as the last barrier would bring 79.00 as the main short-term target back in focus. A negative tone on the daily chart with the upside barrier being reinforced by 90 days moving average currently at 80.20 zone, as the pair reached 80.13 and stalled there, with the brief break above main bear trend line shown so far as a false. Further extension of the short-term downtrend of year's peak at 84.17 would be the likely scenario, with the break below 79.13, 61.8 Fibonacci retracement, and 79.00 to open next target dynamic support of 200 days moving average, currently at 78.53. On the short term, just to mention, 80.00 and 80.13 now act as initial barriers, and regain of these levels is required to revive the short-term bulls ahead of more significant 80.60, 80.70 zone. Previous peaks of 2nd and 3rd of May, as well as 16th of May, that kept the upside limited for a couple of weeks, ahead of 61.8% retracement at 80.71, and only break above these levels would be seen more supportive for the pair and would allow for a stronger recovery. For now, the downside pressure still keeps focus at 79, as the downtrend from a yearly high, as mentioned previously, remains so far intact and looks for further extension lower. The dollar Swiss regained strength after finding support at 93.66 as a part of corrective action of 95.00, previous high posted last Friday, where the 55 days exponential moving average contained the dips just below 23.6% retracement of the move from 90.41 to 95.00. Fresh strength seen in past 2 days has reached again 95.00 as our initial barrier, with some corrective action seen at this point due to overextended the hourly studies, with the mild correction seen before fresh strength emerges and attempts again above 95.00, as the current pullback reached only 23.6% retracement and holds above this level at 94.65. We see the prospect of fresh rally. However, further easing is not ruled out at this point, with the 94.40-50 zone, where it's 38.2% retracement and 20 days exponential moving average ideally expected to contain any further extension lower in order to maintain the larger picture bulls in play for a break above 95.00 that will focus 95.45 mid-December 2011 peak, and our main upside barrier at 95.93, yearly low posted on the 9th of January 2012. On the downside, loss of our initial support at actually our reversal point at 94.30-40 zone would in a way delay the short-term bulls, as also 55 days exponential moving average lies at this zone, and would keep the 95 level intact for the time being, and most likely further ranging would be the scenario, as long as high low of last Monday at 93.66 hold. Only loss of this level would be signal that a possible stronger correction will occur, and a deeper reversal of the current the short-term strong rally from 90.41 to 95 would focus levels at 93.24 as 38.2% retracement, and 93.00 as very strong support. And basically only loss of 93.00 would more significantly weaken the short-term structure of 90.41. As mentioned in the introduction, the gold remains under pressure again after a failure to break above our initial resistance at 1600 zone that was hit on Monday, and subsequent easing reached so far approximately 61.8% retracement at 1555, retracement of the latest rally from 1526 to 1600. That keeps the upside intact for now and reduces hopes of a stronger recovery. As shown on the daily chart, the strong downtrend of 1800 zone that was hit at end of February has tested our very significant and critical support basically at 1530-20 zone with the immediate bounce followed on a test of this level, but so far the recovery attempts are struggling to show any stronger results, as a break above 1600 was required in order to confirm positive action of 1526, whereas that marks a 50% retracement of the latest down leg from 1671 to 1526, and also above this is 1616 seen as the next important target, and the barrier at 61.8% Fibonacci retracement. So far these levels stay intact, and the risk is now turning towards the downside as the studies on the 1 and 4 hour charts are firmly negative and see no much potential of stronger recovery. For now, only regain of 1590, 1600 would improve the current outlook with reversal and the base seen building up at current lows. Otherwise, further weakness and the possible revisit of critical support at 1530-20 zone would be the likely scenario, and a break below these levels would open way for a more significant correction that is already underway of record high of gold at of 1920 posted on September 2011, and basically that will be the first more significant corrective action in the past 10 years, as the pair already dropped quite significantly from 1920 to 1520 zone. This is as said, the first significant, the biggest actually correction in past 10 days, strong rally that made gains from approximately $300 levels that was gold at that period to reach close to $2,000 per ounce in just 10 years. And finally, a quick look at the crude oil that lost traction again and dipped to the fresh low this morning at 90.84, so far below 91.00, as strong pressure on the oil price due to the lower demand and current crisis keeps driving the oil price lower. Loss of significant supports of first $100 and 200 days moving average at 96.40, along with the 95.40, the low of 2nd of February, and the more significant 92.70, and now opens way towards for further extension, a 61.8% Fibonacci retracement of the longer term uptrend from 74.94 to 110.53, that stands at 88.54, is seen as the next target on the downside, with the possible revisit in case the situation stays like this. Possible revisit of 2011 low at 74.94, not ruled out in the short to medium term period. Back to the lower time frames, immediate resistance seen at 93.27, yesterday's high, above which is dynamic resistance at 94 zone, 55 days moving average, and basically only break above this level would give some more significant support for the oil price and allow for a stronger recovery. However, prevailing trend remains bearish, and the downside firmly in focus, with some mild corrective actions seen as pausing the current downtrend, but no significant movements as long as 200 days as our reference at 96.60 currently stays intact. Only break above 200 days moving average would give a more significant signals for the stronger corrective action of the crude oil. That was all for today. I would like to thank you all for attending our live session. Also, the recorded version will be shortly uploaded in the Windsor Brokers page in YouTube called the Windsor Brokers Forex, where you can find also some other technical analysis and comments. We'll be back tomorrow morning with the fresh news and updates at our usual time at 7:00 GMT. Until then, I wish you a nice day and very successful trading. Good luck.